Hey dividend investors, today I am going to be talking about my diversified BMO ETF portfolio strategy. Basically, if you are looking to be totally diverse, having the highest dividends in Canada, these are basically for you. So let's check out some of these ETFs. These are actually really good. So the first ETF that I'm going to show you is ZDV. That's a BMO Canadian Dividend ETF. From there, basically it's going to be holding some of the bigger dividend paying companies in Canada. From there, what are we going to see? Well, right now, currently they are paying a 4.8% dividend. Could be lower in the future depending on how high the ETF price rises. From there, it doesn't have all that high of a management fee. All it is 0.38%. And the nice thing with this is it does pay a dividend every month. Basically, it would be 4.8% divided by 12 every single month. The market volume is also pretty good for an ETF. It's got 178,000 shares trading every single day on average, so not bad. Now, what I like to do is look at its all-time performance since it first started. It started at, let's say it started with you having $10,000. It's gone up about 70%. I am not going to be including this part because, of course, the coronavirus happened. But it is recovering quite nicely, and it is off of its all-time high. So this is definitely a great story to have. We've seen dips before. It's recovered nicely, and we're going to see that again. As we can see, it does pay a dividend, and basically the same dividend every single month. So I can only assume that they are taking all of the companies that they have, dividing up their dividend for the year, and then paying it out monthly so that you have a nice steady cash flow coming in. Passive income is a great thing right now. Now you want to really see the holdings, and do you agree with what they hold? Will it work in your portfolio? So of course, we have a lot of banks when it comes to the top 10 companies. We have a lot of banks. And from there, oil companies. How many oil companies? Well, we have Enbridge, and then I would classify CNR as an oil company because they do transport a lot of oil, but they do also do a lot of grain. So these are some of telecoms on here as well. So these are some of the highest paying dividend companies, and they seem to be pretty well set for the future. I do have my own thoughts on BCE, which is Bell, as well as TELUS. I personally, in my own personal portfolio outside of this ETF, I personally would never invest in those two companies because companies like SpaceX with their internet satellites are going to be eating Bell's and TELUS's lunch like crazy over the next couple of years, in my own personal opinion. ZWC is the next ETF I'll talk about, and this one is another high dividend payer. This one is a covered call strategy against the Canadian banks. From there, what do we see? Of course, if you want to know what a covered call strategy is, I do have videos on my channel about that. Now, currently, it does pay an annualized distribution of 8.15% at the time of making this video. However, that could go down depending on how high the stock price does go up. It does take a higher management expense ratio. It does take a lot more money from you versus the first one I did show you. However, how I look at it is, take that 0.7 away from the 8.5, you have roughly at that point a 7.4% dividend. In my mind anyways, that's how I like to look at it. And with 1 million shares crossing the table, you're going to be able to get out of it quickly, and it also does pay monthly. Now, these first two ETFs are Canadian, obviously, and I do live in Canada. If you live in the States, it may be different. Now, it hasn't been around for a ton of years. It's been around since 2017. It had a pretty good return on investment up until the coronavirus hit. When we start to put our mouse over top of it, it had 17% return over 3 years, so not a massive return, but you are getting that higher dividend. So if you're looking to retire or just have some passive income in case you lose your job or whatever, this may be a fantastic option. It does pay an even amount every single month of 11 cents per share, And the nice thing with a lot of these BMO ETFs is they do sometimes do a one-time reinvested distribution, which ends up being quite high versus what their average cash distribution is. And of course, when it comes to the banks, they are going to be some of the top held positions in this ETF. And of course, it's going to have Bell, TransCanada, which I mentioned in another video, Enbridge, and CNR. So how I like to look at this ETF, ZWC, is a nice way to stabilize the up and downs of your portfolio when it comes to holding the other ETF, that first ETF in your portfolio that you will have. ZWK is amazing as well. So this one's been having some massive returns lately, and BMO covered call US banks. So this is a covered call strategy that holds US bank stocks. From there, this has been really growing. Its closing market price is $26. It was close to $22, $23 not very long ago. So massive returns because of that coronavirus pandemic. It's still paying an 8.5% yield as of December 31st. And something else that is amazing with this is if you did and you were lucky enough to get it way back in the summer, this was well over 10%. So massive returns. Also does pay monthly dividends and has 100,000 shares crossing the tape every single day on average, so it's easy to get out of as well. The risk is of course a bit higher because you are dealing with currency risks at this point, and the American banks are not like the Canadian banks when it comes to the ability for them to withstand a lot of downturns, so keep that in mind. This also has not been around for very long. It's only been around since 2019, but in that year before the downturn, it was up 11%, and since the downturn, it has returned quite a bit as well, which is huge. Like if you're saying, let's say 7,500 up to 10 grand, that is a good 33% return if you were have to bought it down here. Again, the past results don't exactly tell you what happens in the future. Now, when it comes to the dividend, again, it is a bit higher. It's generally 18 cents per share all the way through. But again, a lot of BMO ETFs do pay a special distribution every 2 or 3 years. So personally, if the stock continues to rise, if they start raising their dividends and they can make some money off those premiums for that covered call strategy, I would assume over the next couple of years they will do a massive distribution of reinvested distribution for this ETF as well. Some of the holdings that they do have are great, and I really like them. Citigroup is and JP Morgan, Goldman Sachs, these are all massive banks. Some of these banks also pay huge dividends as well, so keep that in mind. You're not just making money off the premiums, you're also making money off of the dividends as well. So now we have invested in Canada and the United States. Now we are looking at the global high dividend covered call. So this is a covered call strategy. Once again, you're going to get generally higher dividends from these. This one's 6.6%, so not as huge as the US bank one, but still really good. It does pay, or it does charge a 0.72% ratio, but its market volume is really low. So keep that in mind. It's going to be a little bit harder to sell this one. If we look at the historic chart, it's not very old. It took that dip, but it's pretty well leveled out. It's not back to its high, so I would assume if the European and other markets around the world continue to recover, I would assume that to tick up just a bit more. This one's a European high dividend covered call, ZWP. This one's another one that I really like because it does have a 7.2% dividend. And again, management ratio is a bit higher. All of these, what I'm mentioning today, do pay monthly dividends, and its market volume is 31,000 per share, per day on average. So a little bit easier to get out of than the last one. Price and performance since the beginning of time, 2018 versus now, pretty well level because of this downturn. But since then, this part was a bit higher, but you're not looking at a massive gain. The reason why is Europe's going through some junk right now when it comes to the UK and everybody trying to get away from the European Union. So Don't expect there to be massive equity returns, just expect that dividend to be around for a while. This one is personally my favorite right now, and because my camera has died, I would like to say make sure to hit that like button, subscribe, hopefully my subscribe picture is up here, and of course check out my next video over here. I'll see you guys again next time.